Hey, thanks for watching my video here. I'm going to talk about pre-65 healthcare. My name is Matt Benson. I run a financial planning firm in Chandler called Sonmore Financial. We work with retirees or those approaching retirement. And as you can imagine, a very common question, actually, I would say a very, very common situation that we get is somebody that is looking to retire, but they're fearful of what that future cost of healthcare is going to be. And as a result, they end up, saying, "Hey, I can't retire until I get to 65, because I need to make sure I can be on Medicare before I can retire." And that's not always true. So I want to kind of uncover some of that myth, if you will, and kind of go through the way that you might think about it. So the first thing that you need to I guess I'll go over kind of what I think are some of the main options that people will use for healthcare before 65. So, and these aren't necessarily in this order. I think for everyone's situation, it's going to be a little bit different. But I'm going to highlight where these situations, kind of the pros and cons to each option, and then hopefully that'll help you determine in your situation what might be the best option. So the first one, again, not in any particular order here, is COBRA. 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 So when you leave your employer, you can take your employer coverage for if you have work coverage to work, you can carry your work coverage for up to 18 months after you retire. The nice thing about this is that, for a lot of people, if you have a robust health insurance plan through work, you get to continue that robust health plan. The negative to this is that you end up footing the full bill, right? So for a lot of employer health insurance plans, they're subsidized. If you go onto COBRA, that plan is no longer subsidized. So that's a negative to this one is for a lot of people, it ends up being, depending if you're single or if you're married, for a married couple, I would say oftentimes it ends up being somewhere between like 1,500 to 2,000 bucks a month. Whoops, a month on that. If you're single, it ends up being, roughly half that. Um, the situations where people will go on COBRA is if they're retiring and they only have to get coverage for just a couple months before they turn 65. That would be one. The second one would be if they know that they're not going to qualify for a subsidy on the Affordable Care Act coverage, then the COBRA option can be quite compelling because there's no income limitation. So, and you'll see here when I talk through the ACA or the Affordable Care Act coverage, um, there are significant subsidies to be had in that, but you have to keep your income really low. And if you've watched some of these videos or read some of my blogs before, it's conflicting with one of the really good planning opportunities is typically in that window from when you retire until you start drawing Social Security or until you have RMDs. We call those the gap years, and it's the best time. It's where your income's typically the lowest. So it's a good opportunity to do Roth conversions, right? Well, Roth conversions are going to compete directly with your desire maybe to keep your income low if you're trying to stay on an ACA plan. So COBRA, again, good application. Where we typically see it used most often is one, it's a short gap that we need to cover, and you're just like, you know what? I know that I might be able to go get more cost-effective coverage elsewhere. But I really, honestly, I just want to make sure that my doctor network stays the same. I know how all this works, and my scripts are how they're covered and whatever else. So that's kind of the applications where I typically see COBRA being utilized. It's a short gap, or you're going to be over the income limit. Whoops, yeah, sorry, I didn't get all in there. Over the income limits for ACA, and you're like, hey, I'm going to end up spending, over $1,000 a month on health insurance anyways. Might as well be on the plan that I know. Uh, the second option, again, not necessarily in any particular order, would be an ACA plan or Affordable Care Act plan or healthcare.gov. They're all synonymous, right? And you can use a health insurance agent to help you look at these options here. The nice thing about these plans for a married couple in 2026, if your income is below 84,000, then you would qualify for a subsidy. That subsidy, again, for a married couple right now, it's about $1,400 a month. So, like I just had a client that I was looking at this for, and they were 63 and 60, 63 and 60. And so we were looking at an option that would have cost like about $2,100 a month or a little bit less than that. And then after their $1,400 a month subsidy, then it ended up being $700 a month. And that was for like a plan that had like think it was a $6,000 deductible with a $9,000 max out of pocket, something like that for 700 bucks a month. That's not nothing, but $7,000 is certainly significantly cheaper than $2,000 a month. And for a lot of our clients, they're not spending that much less than $700 a month on coverage anyways. You might actually already be spending about that much. So looking at these numbers, I think really helps. Now, the thing that's quite interesting is that if this amount goes above 85,000, if you're greater than 85, then the subsidy goes to zero. So it's very, 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 very important that if you're in those retirement years and we're trying to qualify for an ACA plan, that we got to be very granular about our tax projection. So we gotta make sure that the right hand knows what the left hand is doing. You don't want to say, oh, hey, we're doing good all year. And so what that means sometimes is that, hey, let's say that you need, you know, $8,000 a month to live off of. Well, $8,000 a month over 12 months, that's going to be greater than your 84,000 here. So that means that, okay, maybe we take some of that distribution from an IRA. Maybe you may be drawing some from Social Security. You may have to draw some from like a Roth IRA or like a non-retirement account to stay beneath that 84,000, right? And again, like you're not having to do this forever. So we'll have situations with clients where it's like, but a $1,400 a month subsidy, or if in technical terms they call this the premium tax credit or PTC, if you want to sound cool at a party. If you want to be cool at a party, here's a note: don't talk about don't talk about taxes. That's what they call this subsidy. They call it the premium tax credit. And if you go over this, you can lose it entirely. So it is certainly something worth trying to solve for. If we have, 3, 4, 5 years, if you're retiring at 60 and we have 5 years where we're trying to solve for this, well, we really have to kind of figure out, for some of our clients, it's like we can keep you in that threshold for, maybe, 4 years, but maybe on the fifth year, we're going to go in excess of it. And if that's the case, that's just kind of the way that it ends up going. But hey, we got, maybe 4 years of that premium tax credit where we didn't have to pay the full bill of the ACA plan. Negatives to, obviously the obvious positive is the subsidy. The negative to these ACA plans is they're different than, your group coverage now. A lot of them are HMO plans as opposed to, if you're on a work plan, you might be on a PPO plan. So the doctor network is typically a little bit more narrow. So when we encourage clients to go onto these, we usually send them to a health insurance agent, and that health insurance agent asks, okay, what doctors do you go to? What prescriptions do you take? That kind of stuff. So that way they can find one that's going to be the most in line with what you are already doing as it relates to that subsidy. Well, trying to get sophisticated over here and uh, realized I didn't have my screen sharing or my face showing the whole time. So sorry about that. All right, the third option that we'll have people look at is look at what they call medical bill sharing plans. So medical bill sharing, they're typically Not always, but the most common ones that I see, they are typically faith-based plans. So there's one called MediShare. There's another one called Christian Healthcare Ministries, and there's several others as well, and they all operate somewhat similarly. Um, The nice thing about these is that there's no income thing that we're trying to work around like there is on the ACA plans. Typically, the coverage is less than what you're going to spend on the full rate of an ACA or what you would spend on COBRA. And it just kind of depends on what you're looking at. I would say two negatives to these ones here. So the positives on these is they often end up being lower cost options than COBRA or the full price of a healthcare.gov or an ACA plan. The negative to them, the biggest negative I would say in particular for retirees, is that they are technically not insurance. And why that matters is if you are looking to uh, not insurance, right? So a couple things on that. One is that they, uh, if you like read the nitty gritty of it, oftentimes their terms will say that they don't have to cover a claim, and that is true. Sometimes a lot of times for the faith-based ones, they'll have narrow things where it's like, if you're hurt, if you're injured in like a drunk driving accident or something like that you were at fault for, like they're not going to pay a claim on that because it's not biblical. Um, if so that's one thing, and then the other is that because they're not insurance, they can discriminate on pre-existing conditions. And that's kind of the main one that is, I would say, most troublesome for a lot of retirees. Even if you're in good health, a lot of people will still have some sort of health condition, maybe not a condition necessarily, but something that potentially wouldn't be covered. So anytime I tell someone if they're going to go look at an option like one of these bill sharing plans, I always encourage them to say you want to be overly transparent about like your health history, because if you're taking medication for high blood pressure and then you have a heart attack, we want to make sure that anything that we think that you potentially could have, we don't know that it's going to be covered. So those are kind of the three main options that we have people look at. There's obviously the other one as well is not necessarily obviously, but it's for some people they will have subsidized health care from their employer. If you have that, those typically are going to be some of the best options because they're subsidized from your employer. Those are pretty rare. I don't run into that very often, but they do exist. If you're watching this or reading the blog and you're like, wow, I didn't know that was even a thing. Well, not many people have it, but occasionally we'll run into it. And those typically end up being, some of the most price competitive options. And then again, the nice thing about it on those is there's no income limitation. So hopefully that helps. If you have any questions, certainly feel free to reach out. Always happy to talk through these things with you. Talk to you soon.